Hello everyone, I am Anurag Pathak. In this session, we're going to see some important topics of UPSC prelims in economics. And with that topic, we'll try to see some of the last question, and with the reference to the last question, we'll try to see possible future questions. So I have taken this topic today, credit creation, which is what I have noticed is one of the favorite area where the UPSC has formulated many questions in last 5-7 years. And I have taken this as a reference question. And this question says that which of the following statement best describes the credit creation? So the A option is it is a process by which the commercial banks create a new money. Option B says it is a process by which the government creates a new money. C, it is a process by which the individual creates a new money. And the D is it is a process by the companies create a new money. When you see this question, we have some additive part of this options written. It is to let you confuse more. So we're going to see the actual meaning of and the actual concept of the credit creation. So what is the motive of this video? We're going to see these three segments of the credit creation. We'll see what is this and how does it work, and then what impact it has in the economy. So in fact, so what is credit creation is, to understand this, you have to look at and establish a relationship among these different events of this process. So credit creation is basically, it starts within a commercial banks. So it is an activity which is facilitated by commercial banks and financial institution like an NBFCs. So what is that actually? It is through these commercial banks and financial institution, money supply in the economy expands or sometimes contract. So due to the expansion and contraction of the money supply, the new money comes into the economy. So it is actually run by commercial banks. So which banks are known as commercial banks? All private, government, and foreign banks which are intent to make profit by receiving demand deposit and extending loans. So when they are indulged into expansion and contraction of the money supply, how they do so? By inviting demand deposits. It is within accepting demand deposit, and with the reference to these demand deposits, they extend loans. And when they are doing so, they are creating a new purchasing power in the economy. So creation of the purchasing power is actually a outcome of credit creation. So how it all happened? What is the procedure we have? So for the reference of that, I have this diagram. So let us see. If suppose we have the bank one is SBI, and in this bank we have some net deposit, and for that we are going to use this word NDTL. Now what is NDTL? Like normally we have deposits in terms of demand deposits or time deposits. So what is demand deposit? It is a deposit in terms of the saving account or current account. Time deposit is a fixed deposit. So every day when you go there in the bank, you'll find there are many people who comes to deposit money, and there are many who are there to withdraw money. So the difference between deposit and withdraw is known as net. Now, when we have a net demand and time liability is there in the bank, now the magic starts. So let us assume in a given day, some 1,000 rupees, 1,000 crore, or something of 1,000, multiple of the 1,000 is within a bank. Now, if some 1,000 rupees is there, now the bank has some reserve. Now, this reserve is known as fractional reserve because one part of the reserve is of RBI, and which is under CRR and SLR. Now, this reserve is also known as required reserve or varying reserve ratio. Why we call it a varying reserve ratio? Because it is subjected to change. Now, what is left now? So normally, let us assume for the simplicity of this video, we're going to take this as a 20%. Let us suppose in a given condition, CRR is 4% and SLR is 16%, though we have a different value now. It is an 18 around and 4 years. This is 4. So let us assume it altogether we have 20 is in a VRR. So 80 is the rest of the money. So the rest of the reserve is known as excess reserve. Now, it is excess reserve where banks are having a kind of control. Now, through excess reserve, these banks extend loan in the market. So there we have a fractional reserve, or simply I am writing a reserve here. So whenever we have NDTL is there, net deposit is there with the bank. Bank has some segment as an excess reserve through which they extend loan in the market. So moment they extend loan, let us suppose 1,000 rupees is an NDTL. Now these banks are having an 800 rupees of scope to create a loan. The moment this loan will come into the market, that will going to qualify as new money. So what is this new money is? And the money which is going to add a purchasing power of the economy, or which facilitate exchange of goods and services, because the money is treated as a medium of exchange. So if the loan is there, there's a new creation of the money. And this is also known as credit creation. Now, this is not all the end of the story here. So we have a credit creation. So which banks does a credit creation? Normally we think it is an RBI, but like it is in a commercial banks through which credit creation like happen there in the economy. RBI controls, it considered as a credit controller. Commercial banks are credit creator. Now, once this 800 rupees is there in the economy, we have a further chances of like deriving of a new money out of this 800. So that 1,000 is known as primary deposit. That is known as primary deposit. And now from this primary, some money is derived. When this 800 is taken by a customer and deposit to another bank, now this 800 will going to qualify as a secondary deposit. Secondary deposit. So now you can see this deposit, secondary deposit, will going to add capacity to the next bank, because the same 20-80 ratio will work in every bank, because every bank, it is mandatory for every bank to manage and follow this. And like these all banks are compelled under IBRA, Indian Banking Regulation Act. They have to follow these guidelines. So when they receive some net deposit, let us assume that the next bank is having an 800 rupees in net deposit, which is derived from SBI. So this 800 will going to be part as 160 this side and 640 other side. So 640 will going to become an access reserve for Punjab National Bank, and let us assume the entire 640 is there in the economy as a loan. Now this is again a new money. So you can see here with the one deposit of 1,000, we have many points you will notice where the new money is going to create. Because now 640, let's suppose somebody has taken 640, deposited to another bank. Let us suppose that he holds in a bank account in ICICI. Now once 640 will come into this as an NDTL, let us suppose it is an NDTL. Now, like within a 20-80 ratio, 128 will going to become an RBI's money, and then 512 will become this ICICI bank. Now this 512 will going to be come into the market, so that will also going to qualify as a new money. So with the deposit of 1,000, we have several points developed where the new money will going to be coming out of the economy. So this is how the credit is created. So what we have noticed here, the credit creation happen when there is a bank transaction takes place. Second, when the people are having a more faith, when like the people will keep their money, and then loan going to be like demanded in the bank, and the loan is given to the customer. So the credit creation happen when there is a loan demand and loan acceptance and loan creation in the economy. So credit creation is exclusively run through banking transaction. Now, credit creation to be more effective, we need in a series of banks. So it happens wherever we have a banking habit is more, economy is more organized, transaction is through banking, like a transaction is more. So that is there, the credit creation is very effective and is very much fully developed. So economy without banking structure, banking network, so there will not be so much credit creation. So credit creation ultimately will lead to purchasing power in the economy, and that purchasing power will going to expand demand. So it is through credit creation, RBI try to manage expansion and contraction of the demand. So the expansion of demand will going to, it acts as a fundamental for the economy, because if the demand is more, we have more supply. There is a possibility of the supply going to be there in the economy. So we can see like how this credit creation will going to affect the economy. So for that, I have created one equation here. So there we have a VRR. VRR is RBI's money, and which is actually comprises of CRR and SLR. Let us suppose if we have some changes in VRR, will have an effect on the excess reserve. So when the excess reserve will expand or contract, either expand or contract, we have an effect on the loan. If we have a large excess reserve, we have a many loan amount will come into the market. And when there is a loan is more, we have a more credit creation. Now this credit creation is actually a new money. Once the money is there, money means there is a purchasing power is there in the economy, RBI is going to print money. And the printing is qualified as a money supply. So if there is a loan, more loan comes. So to like facilitate those loan in the market, RBI does what? Looking at the dimension of the money supply, credit creation, accordingly RBI print money. So when there is a money supply is there, more money is there in the economy. So money supply is otherwise money in circulation in economy. So the more money will circulate in economy, and then either due to the increase in the purchasing power, there will be two possibility we have. Either inflation will increase or growth will accelerate. So it depends, like the demand will going to promote more supply in the economy. So in that case, the GDP growth would be more. And if the demand will not going to support production, in that case, the inflation will come. So it depends on the equation to equation, scenario to scenario. So we're going to take those examples in later videos. Now, looking at this equation, we'll try to see some of the possible questions. So this is already the question which we have seen in the beginning. So this question says, which of the following statement is best described as a credit creation? So the option is true here. Why? Because it is in a credit creation is related with commercial activity, commercial banks activity. So it is basically within a commercial banks related transaction. So other options are not related with the credit creation. Now try some more possible outcome of the credit creation. So the question says, which of the following is or are true about credit creation? So the first option is credit creation is a process by which the banks create a new money. Yes. So this is true. It's the commercial banks which creates a true money, new money. Now, second option says the fractional reserve system allows banks to lend out more money than they have in the reserves. And yes, in fact, like if some cash is there in the economy, they extend loan in the form of the checks. So that is how they create a new money. So the cash in the bank will make the banks capable enough to extend loan in the form of the checks. So that is how credit is created. So we'll have some video on fractional reserve also. You can see when you scroll down, you'll find many videos related to the banking transaction. The third option says Finance Ministry regulates credit creation to manage the money supply and maintain stability. So basically, it is not Finance Ministry, it is Central Bank or RBI in India. RBI regulates credit creation in India. Now the fourth option says the credit creation always fuel economic growth and development. So credit creation, there is no guarantee that it always, there would be some chances it will going to create an economic growth, but there would be other alternate possibilities there that this will lead to what? Inflation. So that is why this sentence is not fully correct. It is not always. It can be. It can fuel economic growth and development. Now the fourth option is the process of the credit creation can be impact different sectors of the economy, such as housing, small business, and etc. Yes. So credit creation can lead to what? Through change in market interest rate and all. It can add demand to some specific sectors or divert demand. So in that way, they can support sometime and sometimes discourage other economic sectors. Now let us see some more possible question. So the same question, which of the following is or are true about credit creation? So see, the first option says the credit creation is closely linked within a concept of money supply. Yes. So more we have a credit creation, more we have money supply. They are directly related with money supply. Second option says the Central bank use open market operation, reserve requirement, and interest rate policies to manage credit creation. Yes, to manage or to control. So that is why central banks or RBI in India is qualified or considered as credit controller. Okay, so this sentence, second statement is true. Third statement says the credit creation process can have a direct impact on the inflation. Yes, in fact, it has a direct impact in the inflation. Direct impact, but like it is not like always true, but like yes, if there would be more money is coming in the economy, this will lead to an inflation. Then credit creation process can't be influenced by the global economic conditions and geopolitical events. Yes, they can be, because like American rate of interest, because you can see this time also RBI is following the procedure of looking at the trend of the other central banks of the world. Accordingly, they are taking care of credit creation in Indian economy. So this much we have for this session. I'm going to bring more videos on such topics. So thank you very much.